Hello, nice Tuesday. Before we start, I want to give you a little sketch of how the lecture of today will go. So, firstly, I want to briefly review what was the financial crisis and why we focus on the financial crisis shortly to remind what we did, and then we only have 2 or 3 slides left, so we're gonna finish very quickly. And then what we're gonna do is not going to chapter 2, but I'm gonna do the chapter ending part. So what does that mean is this is part of your homework assignment, right? So I assign the homework assignment from the chapter ending of each chapter. So it looks like this. So here we have the summary of the chapter, and we can look at the key terms of each chapter. And then there starts the questions, right? So starting with the concept questions, it develops to the analytic questions or much more deeper questions. So I am going to assign the homework question from here. So I want to do it before, right? So I'm gonna check like 1, 7, 8, 9, 10, and 16 today, and I will assign different number of questions for your homework. Okay, so let's go back to chapter 1 and do it quickly to finish the chapter. Okay. One second, I'm still searching for the page. Okay, so financial crisis of 2008. So what was the problem with this? These financial crisis 2008 originated from subprime mortgage backed securities, right? Caused systemic risk of the shutdown or the failure of the whole market, right? So what was the subprime mortgage-backed security? This is like literally subprime. They are not prime rate, right? And this is for a loan, and this is for house, right? So you are banking out the loans for the subprime grading people, right? Without much of backup, right? So what happened was these failed, right? So all of the market failed. And then we found out some solutions, right? We came up with the solutions of systemic risk of Dodd-Frank Reform Act, right? So after the financial crisis of 2008, we want stricter rules for the bank capital liquidity risk management, right? So we want to increase the liquidity of the bank asset, right? So we saw at the balance sheet of the commercial bank, we had the real asset, financial asset, we saw almost like 90% or higher of the financial asset, which is at the very high risk in the occurrence of this crisis, right? So the government want the commercial banks to increase their real asset part or their depository funding, right? And they mandate increased transparency, right? And clarified regulatory system and limited ability to trade for own account, right? Not on behalf of the customer. If you do it for your own, this is limited, right? So banks were able to do tons of different things without letting know the investors, right? So inside of the bank, we have commercial bank, investment banks. But anyway, both banks were able to do a lot of things without much of regulations. So that's when the financial crisis of 2008 gave a massive hit, right, of falling the house prices. So after that, to protect the investors, we mined out some regulations to protect investors from this massive failure of banks. So let's look at the figure 1.1, short-term LIBOR and treasury bill rates and the TED spread. So before, let's look at what are those, right? So short-term LIBOR is the short-term interbank interest rate, and this is for worldwide, right? The L in the LIBOR stands for London, and London is where all the banks were located in the before this 2000 era, right? In 19th centuries or 20th centuries. So it's called the LIBOR, and most of all the banks who are working internationally are tied to the short-term LIBOR, right? And we have another concept, treasury bill, right? So not only treasury, but its rate. So what we're looking at is treasury bill yield, how much percent you will get, right? What is treasury bill? It's very short-term government debt, right? So if we purchase a treasury bill, it's promised to give us some yield percentage, right? So what we have in common in these two concepts, both are short term, right? So we want to compare what? Worldwide short-term interest rate versus US short-term interest rate of treasury bill, and that we call the difference between two are called TED spread, right? So we can call the TED spread equals to 3-month LIBOR rate negative 3 months T-bill rate, right? So if we see positive, right? If the TED is positive, then we can say, oh, LIBOR is greater than T-bill rate, right? And if the TED is negative, we can say LIBOR is smaller than the T-bill rate. And if they are same, we say, oh, those are same. So the difference between LIBOR and T-bill is called the spread, right? So the bigger the spread, the more the LIBOR is bigger than T-bill. And if TED is really small, we say, oh, T-bill is give you bigger than LIBOR, right? So let's look at the spread first. So let's capture the spread. Firstly, when we started January 2000, right here, right, the spread was that much, right? The blue line is LIBOR, and the red line is T-bill, and the green line stands for the TED spread, or the difference between 2 points, right, or the 2 graphs, right? So at 2000 January, what T-bill has that rate, LIBOR has that rate, and the difference was 0 point something percent, right? And moving on, it spreading up a little bit, and then it came back to closer. So why these are having very tightly moving together? Because what? US world, it's about banking, right? So who leads the financial market? Is it still London? We think is the United States, right? And also the world is having its own power. So if the world interest rate moves, right, US interest rate moves, and the vice versa, right? So if US interest moves towards positive, LIBOR would move towards positive also, right? So we have high correlation between the US interest rate and the world interest rate. So what we're seeing is until 2008, right, we see those two lines are very close, right? And then after 2008, what we see is a separate move of the LIBOR and T-bill. Right here we see the LIBOR going up, whereas the T-bill was going down. So what happened? The spread was spiked, right? So we can see the spread was very low, right? Around 1 or lower, and then it went up and spiked right there at around 3.6 something, right? So we see, oh, the spread was very widened. So we know that those two interest rates are highly correlated and they are moving together. So why this happened? This is not because our house price dropped itself, right? It is indirectly the cause of it, but the real reason for it is we checked it, right? To prevent the systemic risk, the government lowered the T-bill rate, right? So government lowered the T-bill rate to make the market stabilized, and then there is no way for the LIBOR to escape from this lowered T-bill, so they were lowered and the spread was very close to nothing again, right? So it was widened when something happens, right? And it comes back to its close point when the financial crisis was solved or mitigated. Okay, so what we want to tell, right? So what was the whole reason about this financial crisis and everything? To make sure that, we've been through a lot of crises, but cumulative return on the $1 investment in the S&P 500 index is continually rising, right? We see, in 2008, some point right there, we had a big crash, right? And in the mid of 2000 and 2004, we had another one. And right now in 2000, we had another one, right? But what we're seeing is it's continuously rising its value, right? So this textbook want to emphasize that if you want to have some bright future with investing your money wisely during your saving era, right? Smoothie right here. So we are in this position of our age of 20 to 25, right? And we're moving to working age, right? So we want to learn the principle of saving and investing to have a better future in these saving ages, right? So we're learning here, and we want to promote you. If you're gonna save and make it bigger, right? A wiser way to do it is not put your money in the savings account, but invest in the stock market or financial market, because it goes volatile but increase, and the increasement or the yield is better than bank, right? And through these eras, we've been fixing the problems of the stock market or the financial markets, right? So let's start investing. Okay, so this was the goal of the chapter 1, right? And let's move on to our ending part to look at some questions. So for the summary part, you can read yourself. I'm gonna skip it, right? But I want you to read it before you move on to the questions of the assignment. And every time I'm gonna do the key terms and then move on to questions. So firstly, what is active management, right? So when we have when we think the market is inefficient, right? Then we have to timing the market, right? To find undervalued securities, right? That we call the active management of your portfolio. And we have agency problem. That is what the agency who were selected to represent the company, not the owner, right? The manager sometimes has what the what we call motivation. Yeah, motivation to go against the investors of the company, right? That we call the agency problem. And what was the asset allocation? It's called what? Top down, right? So if we choose to go, I'm gonna invest my money on the financial market, then we want to what? Select the asset class proportions, right? By the asset class. So we had 1, 2, 3 different type of asset class. One is fixed income, second one is common stock, and the third one was derivatives, right? Derivatives. Anyway, we can select the what? Proportion by asset class. So let's say, I want to have 30% of the fixed income, 20% of the common stock, and looks weird. Okay, 25 and 45% of the derivatives, right? So we can choose this and then move on to what kind of fixed income I want, right? I want T-bill, I want T-bond. For the common stock, what kind of common stock do you want? I want Tesla, I want Apple, blah blah blah, right? For the derivatives, what kind of option or contract you want, right? I want to buy a call option for that maturity, or I want to buy a contract ending at that date, right? So from the bigger category, we go to the each individual securities that we call the asset allocation or top down. And the derivative securities is the third class of the asset we learned, and this is what this is from the change of different security we get the value that is called the derivatives, right? So by the change of the stock price, right, the price of option is changing, that we call the option is derivative. So the option price changes with the change of different security. That's what we call the derivatives. And equity is equity, right? Financial asset we want to distinguish from what? Real asset and financial assets, right? So for the real asset, that is tangible, right? Physically exists, and financial asset we only claim for the value, right? And we have financial intermediaries that connects the investor and companies, right? And fixed income securities is the first class of asset that we call that we learned, right? And this is what part of the debt. So you're giving a loan and promise to pay it back with certain yield, with the interest rate, that we call the fixed income security. And investment is what? Sacrifice today's value, right? Today's time, today's money to have a greater value for tomorrow, that we call the investment, right? So we want to save or invest to have a bigger money in the future, right? So we're not gonna do saving in this class. We're talking about the investment and trying to make it larger with proper risk management of the portfolio. And we looked at the investment bankers. What they are in charge of IPOs, and they're working primarily at the primary market, right? So when the IPO comes out, right, the investment bankers are underwriting all of the IPOs, right? They purchase at the certain price and they resell it to secondary market that we know as NASDAQ, right? NYSE and Dow Jones. And what was the difference between investment companies? Investment bankers are underwriters, right? Underwriters. And investment companies only connect us investment to company through investment companies, right? So why do we need these guys? Because they are more skilled, right? And they are devoting more time and money into the investigation of the company, and they can also make a mutual fund. We might be very interested, right? We're going to talk about that in the near future. And we also have the passive management, which was the opposite of the active, when we think the market is efficient, right? And the primary market, we already talked that, right? We cannot enter into the primary market, we only into the second market, right? The company and the underwriter deals their IPOs in the primary market, right? And private equity is when they cannot go public, right? You privately offer your stocks or share of your company to individual investors that we call the private equity. And real assets are different from financial assets. We know that risk return trade-off is simply if we have the high risk, we'll have high return, right? Or lower risk, low return, right? So if you're looking for high return, you have to search a little higher risky portfolio. We have to comprise a little risky portfolio, right? If you're willing to have the lower risk and lower return, we can go for a very stable portfolio. And secondary market is these market we deal with every day, and the securitization is making something into tradable goods, right? Making something into security that is what? Tradable in financial market. So mortgage itself wasn't a security, but they made a security out of that mortgage. So we got that name, mortgage-backed security, right? And then mortgage becomes a security is the process of securitization. And security analysis is analysis of each security, right? And security selection is selection of its security. So we're going back to the asset allocation, right? When we had the asset allocation, we chose how much of is going to the fixed, this going to the common, that going to the derivatives. But in the security selection, we look at the list of a whole bunch of stocks that we are interested in, right? And we'll look at the whole bunch of fixed income securities and derivatives, right? And we compare each securities inside, right? Let's talk about Tesla, Apple, Microsoft, blah, 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 right? So you can compare the performance of each company, right, with their yielding or how about their growth rate, right? And you can choose, I want to choose Microsoft instead, right? Then it goes to common stock. That is called security selection, right? From here to make that is called bottom up, right? And if we had looked at the crisis of 2008, we know what the security selection systemic risk is, right? So one failure of one market going to a whole bunch of different market failure is called a systemic risk, right? And the venture capital is something very related to private equity, right? When they first start, when they venture their capital, they have to do the private equity offering. Okay, so let's look at the question. It was very long. Terminology review, right? But the reason I do this is I want to right, remind what that chapter was about, right, before we're looking to the questions. So if you don't know, right, what these numbers are the tips, right? These are the tips to find where to find the investment bankers. This is only connected to the textbook page, right, of 14, right? Page 14 will give us a little information about the investment bankers, right? That's what this 14 stands for. So what I want you to do instead is, because we're not required to have the textbook, right? So what I want you to do instead is, remove these numbers, right? And find the matching page from slide, right? So let's say the investment bankers. Files here. So let me see. We had investment bankers in which page? Yes. Financial assets going out. Agency property. And then we have players, right? There's where we have out there. So at page 22, right, of our slide, we have the players, the title players, and inside of it we have one player named investment bankers, right? So we can get the info of the investment bankers from slide 22. So what I want you to do is, you already noticed that, right? So instead of 14 right there, right? So delete and change to page 22 of our slide note. Then we'll have a quick lookup. So let's move on to our questions. So number 1, right? What are the differences between equity and fixed income securities? So we have to distinguish between equity and fixed income securities. So when we're thinking about the equity, we have to think about, first we have to think about the asset classes, right? So we have 3 classes. We have fixed income, common stock, derivatives, right? So fixed income is here, so we want to compare this to one of these, right? So what is the equity? We commonly call the common stock as the equity, right? So this is comparing what? Common stock to fixed income securities, right? Including preferred stock. So what are the main difference between these two? The common stock and the fixed income security. One is, the main difference is, one is the ownership, right? And the other is, we call that debt, right? So one thing, right, for the fixed income security or the preferred stock, right, what the government or the company is trying to do, right, is they want to raise money, right? They want to raise money by what? Borrowing money from investors, right? So it says, in return, we'll give you the fixed income, right? Fixed percentage of the yield per given period, right? That's called the fixed income security. What about the common stock? If you purchase this, right, does anyone will repay you in the future from the company? No, this is only what? The ownership of the company. So this, you're not owing something or someone is not owing to you. This is only what? Part of the ownership. So if you're purchasing a common stock, you are purchasing the what? Partial ownership of the company. So if the company value of the company, right, value goes up, your stock price will go up. and your selling point is on your decision. For the fixed income security, it has maturity, right? And it has the promised yielding rate. So these are very different, right? Don't be confused with the name of common stock and preferred stock. They are totally different, okay? And let's move on to number 7. So what I want you to do in number 7 is to distinguish between real and financial assets. Okay. So for each transaction, identify the real and or financial asset that trade hands. Are any financial asset created or destroyed in the transaction? So let's see what happened. So it says A, Toyota takes out a bank loan to finance the construction of a new factory. So what is new in here? Before, Toyota had no bank loan, right? And they didn't have factory, right? So what is new? What are new are, we got bank loan and we got a new factory from it, right? So what is bank loan? This is a liability, right? That you have to pay, and the money goes to where? Financial asset, right? So we can say financial asset was created. So I will say created, right? Financial asset created. What about the new factory? This is what? Factory that we make some products from. So this is a real asset, right? And we call that real asset was created. Let's move on to B. Toyota pays off its loan. So we don't know how was the revenue for the Toyota, but they paid off its loan. So what was this destroyed? We had the liability to pay back the bank, and now it's gone, right? So the financial asset was destroyed, right? Number C, Toyota uses $10 million of cash on hand to purchase additional inventory for the spare auto parts. So what's new? This is not new, right? This is existing. And we're trying to get a new inventory of spare auto parts, right? So we're in the exchange of cash getting what? Real asset created. And this is what? Only the cash going to real asset, right? There was a transaction. That's it. Nothing was created or destroyed from number C, transaction. Okay. And let's look at number 9. It's the same logic, right? So we want to look at identify the real and or financial asset that trade hands. Are there financial asset created or destroyed in the transaction, right? So let's look at the assumption first. Lenny Product is a startup computer software development company. It currently owns computer equipment worth $30,000 and has cash on hand of $20,000 contributed by Lenny's owner. For each of the following transactions, identify any real or financial assets been created or destroyed. Okay, so let's look at it. Firstly, from A, Lenny takes out a bank loan. It received $50,000 in cash and signed a note promising to pay back the loan over 3 years. Right. So what happened? What was created? Our bank loan was created, right? This is what? Liability that gives us $50,000 of cash, which is financial asset, right? So we say financial asset created. Number B, Lenny uses cash from the bank plus $20,000 of its own funds to finance the development of a new financial planning software. So I'm gonna use different color. So it says uses the cash from the bank plus $20,000 of its own funds to finance the development of the new financial planning software, right? So what is happening is, the cash plus 20K, right? How much was the cash? 50K, right? So 50K plus 20K transferred to a software, right? To develop a software, they used a cash of 70K, right? $70,000. So we say, what was created? What is this? Real asset was created, right? And number C, Lenny sells the software products to Microsoft, which will market it to public under the Microsoft name. The Lenny accept payment in the form of 2,500 shares of Microsoft stock. So I'm gonna remove it and look at it. So he sold the software to Microsoft, right? Software is gone and it will market into the public under the Microsoft. So they sold all the patent, and in the payment they accept 2,500 shares of Microsoft stock. So what were in exchange, right? So the software and 2,500 shares were exchanged, right? So our real asset is gone, right? So it is destroyed, and we got the financial asset of 2,500 shares of Microsoft, right? Created, right? So real destroyed, financial created. And number D, so Lenny sells the shares of stocks for $50 per share and uses part of the proceeds to pay up the bank loan. So what he did was, now he has 2,500 shares of Microsoft and he sold it for $50 per share. So what was the proceed? $12500 was made throughout the selling of the software, and he used a part of the proceed to pay up the bank loan. So what happened? The financial asset is not destroyed, right? Is it destroyed? It is out of our balance sheet, but it's going to someone else, right? To other investor, right? So it's sold to other investors, so we don't call it destroyed. What about the bank loan? The liability of the financial asset of bank loan is paid back, right? Paid back. So this is destroyed, but we don't call that this selling of the Microsoft share as a financial asset destroyed, because these shares are not destroyed, right? These shares are going to other investors. So we have to distinguish between the selling of shares and payback of the bank loans are different, right? This is nothing. That is the destroy of the financial asset. Number 10 in our whiteboard. So what is number 10? 10 is create balance sheet for given situations. So what are the given situation? Is the situation of number 9, right? So A was asking for what was the balance sheet just after just after it got its bank loan, right? So create a balance sheet of right after bank loan. So what was their asset before they got the bank loan? So in number 9, it says what Lenny's computer has $20,000 of cash, and they had $30,000 dollar value of equipment. And after, right, this is prior to the bank loan, and after they got the bank loan of $50,000, right? So how can we make it into the balance sheet? First, we have to look at the asset, right, and the liability and equity. In the asset, we want to distinguish real and financial asset, and the liability and equity will be liability and equity, right? And the sum of real and financial asset is matching to the sum of liability and sum of real and financial asset equals to the sum of liability and equity, right? That's the balance sheet. So I'm gonna redraw it. This is not good. So they had 20,000 cash, 30,000 equipment, and $50,000 of loan, right? So how can we make it in the assets? Start with the real asset. Do they have any real asset? Yes, they have computer equipment of worth $30,000, right? So real asset, and we make the category equipment, right? And that has $30,000 value. What about cash? Oh, that's financial, right? Financial asset, and we have cash of 20,000, right? And what happened? Oh, we got the bank loan, and the loan takes the form of cash, of course, right? So we got additional cash of $50,000, right? So in total, how much do we have? 30 plus 20 plus 50, in total of $100,000 in the asset part. What about the liability and equity? Do we have any liability created? Yes, we got the bank loan, right? So name first and the value. So what do we have is our own part is called the equity, right? So since asset equals to the liability plus equity, right? So we can have, equity equals asset negative liability, right? What is the total asset value? 100,000. What is the loan value? 50,000. So we can say the shareholders' equity equals to $50,000. So we can have the total of $100,000 in liability and equity part also, right? So that's what we call the balance sheet, and this is how we write it. And that was the part A, right? So let's move on to part B. So what is the question of part B is, let me see. Part B question is, prepare the balance sheet after Lenny spends $70,000 to develop its software product. What is the ratio of real assets to total assets? Okay, so we're gonna get that real asset to total asset also. Going back to our blackboard or whiteboard. So question B is, after spending $7,000 cash to have software, right? So before we had what? We had asset, liability, equity, had equipment of 30,000. We had cash of 70,000, liability of 50,000, equity of 50,000. That's where we started, right? With 100 and 100K on left and right. right? So let's see what's changing. So we spent our total cash, right? Cash and convert it to software. So what happened? Oh, inside of the real asset, right? Real asset, not only equipment, but we have new category called the software that is worth $70,000, and cash is gone, right? So it's transferred to software. So do we see any change in the liability and equity part? No, we see, oh, there is a transitory move from cash to software, right? And we call that financial asset to real asset, right? And nothing has changed in the ending of the balance. But the question asks, what was the real to total asset in part A and B and C? It will ask, right? So I start from A, right? What is the real to total asset? We have real asset of, from A we had 30,000, right? And total asset we had 100,000. So if we divide, right? We divide. Sorry. If we divide the 30,000 by 100,000, we'll get 30% of the total asset is real asset, right? If we going to part B, what happens? Oh, we don't have any financial asset, but all of that are going to be real assets, right? So now we have 100% of the real asset in part B after we change it the money to software. Okay, and let's look at number C, right? So I'm not gonna go back to the question itself because we did it in the number 9. So I'm just gonna say it verbally, right? So for C, create the balance sheet after after you got Microsoft shares. So after you exchange your software to 2,500 shares of Microsoft. So when you sold the software, what happened, or what change happened to your balance sheet? And we're gonna get the value of the Microsoft with the $50 per share, because we know that at the ending part of the number 9, Lenny sold 2,500 shares of Microsoft at $50, right? So if we look at the balance sheet, asset, liability, equity. So we had equipment of 30,000, and we have software 70,000, liability of loan 50,000, and equity 50,000, right? But what happened was, oh, we're selling the software at this price, right? So the software was converted to equities of common stock, right? 2,500 shares at $50, right? So this software is converted to equity, right? So, oh, now it's gone. So what we have to look at is the balance, right? Before we saw no balance change, but since, oh, finally the Lenny sold their product to the consumer, now they have to change in the balance value, right? So what we have as an equity is 125,000. So in total, we have equipment and the equity value of $125,000. So total asset equals to 155,000. So what do we have in here? Oh, asset equals to liability plus equity. our loan size doesn't change, right? So what has to change? The other part has to change, right? So aside from the loan, all of the value of their asset belongs to Lenis, right? So equity is 155000, which is the total asset value negative the liability of 50000. So we have it's increased to 105000, right? So our total of the liability and equity sums up to $155,000, right? And if we get the real to total asset ratio, right? Real to total asset ratio is 30,000 over 125,000. So we got 155,000, right? So I got 0.2, and that represents 20%. So what we have seen is from their venture or the startup, right, to their complete transaction of the selling, right? So Lenny started at the value of balance sheet of 3K, 2K, 50K, and 50K. So equity, liability, we have real asset, financial asset, liability, and equity, right? So we started from 100K, and the real to total asset ratio was 30%. And then they produced software, right? And their balance sheet has changed it. The real asset 100K, right? Liability 50K, equity 50K, and the total of 100K. And then they sold, right, the product. And now their asset and liability equity has changed, right? So real asset remain 30K, financial asset 125K, liability 50K, and equity 105K, the total of 155K, with real to total asset ratio 100% and back to 20%. So what we're seeing is the steps, right? They start and produce, sold, right? When they first start, they have some equipment and money on hand, right? And what they do was, with that money, they produced some sellable goods, right? And they are selling the goods to create another cash or financial asset, right? So we can see when we first started, the real to total asset ratio should be low because we didn't produce anything yet, right? And then when we move on, because we produce from the financial asset, the real to total asset ratio increase by far, right? And right here is 100%, but it increases, right? And then when they sell the product, they get the money, right? So the real asset proportion decreases compared to the financial asset, and that's where we go back to the low real to total asset ratio. So it's a circulation, right? So when they sell product, now they have cash on hand, right? Same story, but a little bit better, right? So if they do it repeatedly, what we are assuming is if they continue their business, because we see their business is profitable, right? From 70K, they made 125K, so they are making pretty profitable business, right? So if they repeat this 1 2 3 1 2 3 1 2 3, right, then we can expect the company to grow, right? So we're expecting the company grow, and that's when we purchased the stock of the Lenis. Okay, so I'm gonna stop here for the preview of the homework, and I will assign few questions, maybe including these ones, because our chapter 1 is pretty short in questions. So in the Blackboard, and you will have a week to complete your homework, and we're gonna discuss more about chapter 2, and if you have any question about the chapter 1, we're gonna do it on Thursday. Thank you and have a good night. Bye.